All right, so here we want to make sure that, like I said, we don't just want to make sure we have money at the beginning and ending of the year. We want to make sure we have it um, at all times. And if we end up with a situation where we are not collecting our money from sales and other means that we expect, we're going to have to come up with the shortfall somehow. So part of the plan may be if there is a monthly shortfall, we might have to rely on either, well, probably short-term notes or possibly long-term notes. But that's all part of it, is trying to figure out whether or not you're going to have shortfalls at any particular period. All right, so what this is meant to show is how you figure out your monthly cash flows. So again, you figure out what cash flows you have coming in during the month, and as well as outflows. So here we have an example of this company. They sell on credit. They on average collect 20% of their current month's sales, and those sales in a current month, 75% of those are collected next month, in the following month following the month of sale. They also, based upon historical information, have cash discounts that are taken for 2%, and there's another 3% that on average are considered bad debt. And so what they're doing here is a quarterly cash collections uh, budget. So January, February, March, they expect sales for those months to be 500,000, 450, and 600,000 respectively. And so they take that information along with the beginning accounts receivable for January 1, as well as uh, well, the beginning accounts receivable January 1 that'll be collected in January, since that actually happened in December. Those are December sales. And so again, January sales being 500,000, 20% of that they expect to collect in January, so 100,000. Um, in February, they expect to sell 450,000, so 20% of that is 90,000. They add that to the uh, $375,000 worth of January sales that they expect to collect in February. So they have total cash collections of 465,000. And then in March, you've got $600,000 sales. 20% of that is 120,000 they expect to collect. They add that to the February sales that they expect to collect in March. So you come up with 457,500 in collected in March. So they've got a total cash collections of 1,562,500. Next thing they're going to do is they're going to figure out their cash disbursements. And based upon historical information uh, of their purchases, that they purchase on credit. And so in the month of purchase, they pay 50% in that month of the total amount of purchases for a month. And in the following month of the month of purchase, they expect to pay 48%. That may be something that's done at the end of the month that's not due until next month, right? And then on top of that, they have cash discounts taken of 2%. So they expect purchases for the 3 months of January through March to be 120,000, 200,000, and 250,000 respectively. And so they come up with the following cash disbursement budget. So they have their beginning accounts payable of 256,000 that they're going to have to pay in the month of January. To that they add 50% of the January purchases of 120,000, so 60,000. They also have an additional amount that they expect to cover other things that they plan on paying throughout the month, and that number is 250,000 each month. So they add that for total cash disbursements of 566,000. If you look back at the numbers, you know, cash collection 640 versus 566. In February, 465 versus 407, and then 457 versus 471. And so there, they've got more in March, they've got more cash going out than coming in for the month. So they might have to do something, do some short-term financing with a lender to take up the shortfall. Or hold some back in previous months. Either way, they've got to deal with it. Let's see. All right, so we've got our budgeted balance sheet example. Some of this comes from information we've already dealt with in the other budgets. So this would be probably the last thing that they do, either that or the statement of cash flows. So I mean the cash would be an easy one to figure out because we did that in the budgeted information, accounts receivable as well, inventories as well, and then figure out what other current assets are and put that in there. Long-term assets, that they have purchases of $1,470,000 for the year, so that would have probably come in some sort of acquisitions budget. And then as far as liabilities and shareholders' equity, accounts payable would be from our budget that we just did. Taxes payable from our what information they already had, plus our estimated tax payment. In the income statement, current portion of long-term debt would be pretty easy to figure out. Long-term liabilities, easy to figure out, even though it's not in the budget, except maybe the $23,000 payment is somewhere in there, probably in that 250,000 other cash disbursements. And then you've got your common stock, no change there. You've got your budgeted net income after tax of 1,149,000, so you add that. You've got your budgeted dividends of 30 that you're subtracting from retained earnings. So anyway, bottom line is these numbers are either in a budget or easily determinable from other areas of the company. All right, so that would be the last thing that you do unless you do a budgeted statement of cash flows, which you certainly could do. Now, in service organizations, you don't have production, you don't have a production of goods. So it's pretty simple, but you do have to budget costs of services, and you could certainly figure out your marketing and administrative costs. So you still have those kinds of budgets. You certainly would need to prepare a cash budget as well as a budgeted balance sheet. And all this, of course, is going to be based upon the amount of sales forecasted for the year. So that's the place to start. Same for merchandisers. It starts with a sales forecast. Now here you don't have a production budget, but you do have a purchases budget based upon the amount of items you expect to sell for the year. You certainly can figure out marketing and administrative costs. And so you can figure out a budgeted income statement. Always good to do a cash budget as well, and prepare from all those things your budgeted cash, or excuse me, balance sheet. So here we have an example of a company. They expect sales, merchandising company. They expect sales of 300 units. They estimate ending inventory of 5 units. Estimated beginning inventory of 2 units. Estimated cost per unit $1,725. So they know they're going to have to sell or purchase 303 items. The 300 that they plan on selling, the 5 they plan on having an ending inventory minus the 2 they already have in beginning inventory. And so there's the purchases budget. All right. What can I say? Budgeting can create ethical problems because many times it creates, I don't know, unintended behavior, I guess you might say. And so here the company must recognize the trade-off between encouraging unbiased reporting by managers and the use of budget information in performance evaluations and rewards. So, again, back to our example earlier, the sales manager who thought that they could reach a certain amount, 7 million, without any problem. And since part of their salary was based upon a bonus of anything they did above that amount, that's what they put, figured budgeted sales should be in the number of units or dollars, excuse me. Knowing that that's the case, the budgeting committee actually increased that to 7.2 million. So you just really have to kind of know that, or figure out what people's motivations might be in fudging the numbers. All right, so that's it for chapter 13.